Well, good afternoon, everybody. Welcome to our webinar today entitled Introduction to Technicals and Trading. My name is Sean van den Berg. I am an investment specialist here at PSG Wealth. I'm also the head of client education. I've clicked on the record button, so this presentation is being recorded. Any questions you guys have, type in the question box. I'll be able to handle the questions at the end of the presentation if there's any questions. Okay, so let's get started. As I say, we're talking about technicals and trading, and this is part of a series that we've been doing over the last 2-3 weeks. Last week we spoke about fundamentals and investing, the basics of fundamentals and investing. Today we're talking about technicals and trading, and next week hopefully we talk about risk management. Okay, so as I say, the focus today is on technical analysis, and we talk about the building blocks. And I always believe in laying down a firm foundation, and that's exactly what we're going to talk about today. So, as an introduction to technical analysis, the first thing you'll want to ask yourself is how do I approach the market? And this is a bit of a recap. So, we talk about share market analysis, and there's two schools of thought. We talk about fundamentals and technicals, but very simplified is we ask three questions. If I bring my little cursor here quickly, okay, here we go, my cursor. What must I buy? And that is fundamental analysis. How good will this company be as a generator of future profits or earnings, or how good will this company be as a future generator of future dividends? So that also a question: what must I buy? And that's broken into what we call macro fundamentals, or you can say the bigger picture, macroeconomics. How does the company operate within the economy? What are the factors that can affect the company, be it interest rates or inflation? And there's a lot of other factors. When we talk about micro fundamentals, this is looking at more specifically the nature of the business, but more specifically the financial statements of the company. And we go one step further. We look at various financial ratios to discuss or to determine where the company is growing, number one, and number two, we also look at the health of the company. We'll say health is risk and things like that built into it. But today's presentation, we're going to be focusing on the question, when must I buy and when must I sell? That is what we call technical analysis. So that's more what we call charting, looking at the charts to help us as a tool to help us make a decision on when to buy and sell. And there's only two factors that's involved here. Number one, price, and number two, volume, or the number of shares traded. Okay. So go one step further now. You ask yourself, and that's what we're going to focus on today, as such as technical analysis. Ask yourself, what is technical analysis? As I mentioned just now, using charts as a tool to help us make more informed decisions. But everything we know about the fundamentals of the company, the financials and things like that, it's all reflected in number one, the share price, and number two, the volume. But going one step further, as I'm saying, is everything we feel or we think or we know about the company, as I say, is reflected in the fundamentals. But that is reflected in the share price, number one, and number two is the volume. Volume, as I say, is people's commitment to price, the number of shares traded. And price, by the way, is determined by supply and demand. We as a group of investors or traders will decide to buy into a share based on future prospects, hopefully positive prospects. We buy into the company, buy into the share, and that creates demand, and demand pushes the price up. From a fundamental point of view, we say the share is overvalued. We start taking profits. From a technical point of view, we talk about the share being overbought near the top of the cycle, and there's more sellers coming to the market and pushes the price down. But price, as I say, is determined by supply and demand. And volume is people's commitment to price, is how much you can afford to buy into the share. Okay, the more committed you are, the more you like the company, the more you're going to buy. Okay, so your goal as a technical analyst now would be to look at the supply and demand, because ultimately it creates trends, number one, and number two, it creates patterns. And your goal as a technical analyst, because these cycles are repeated, is to identify them and to use it to your advantage. Obviously, first of all, to profit, and also it's in the situation to avoid losses. And that's what we're going to discuss today, is these trends and patterns. As I say, basic price action is your primary indicator, but also, we're talking about technicals today, but just understand that fundamentals and technicals together, I like to use both as approach, as what I call rational analysis. The more informed you are about a certain share or sector, the higher the probabilities of being the odds in your favor. Okay, so talking about trends and patterns. We talk about the methodology. So Dr. Alexander Alden, in some of his books, I think it was Trading for Living, he spoke about 3 M's. So mindset refers to it's a way of thinking, and from a trading point of view, you want to think yourself as not about only making money, but you want to see yourself as a consistently profitable trader. So it's that way of thinking, it's that mindset. The other M here is money management or risk management, and that's what we're going to spend a lot of time with next week's webinar. And as I say, today is the third M is methodology or the strategy, and I'm going to touch on it today, but that's the least important when we talk about the 3 M's. Okay, so just remember next week we're talking about risk management or money management, very, very important. It's not about making money, it's avoiding capital losses. Okay, so let's talk about the basics. And as I say, the basics is the foundation. We talk about cycle and trend analysis. These are questions you ask yourself to help you bend the odds in your favor. So we talk about cycles, and there's 3 cycles you get in the market. We have primary, secondary, and the minor cycle. The primary cycle, bring up my little cursor here again, is your primary bull and primary bear. So definition of a bull market is a rising market, first of all, is higher highs. Okay, this high is higher than that one. Okay, and higher lows. This low is higher than that one. So this takes a few months to a few years to build up. Okay, so demand is pushing the price up, or there's more buyers and sellers pushing the price up. So that's the thinking behind a bull market. Demand. In the bear market, falling prices, you see that this high is lower than that one. This high is lower than that one. So it's lower highs, lower lows. There are more sellers and buyers pushing the price down. So this is supply, oversupply pushing the price down. You can also see this here is greed pushing prices higher, and this is fear pushing the prices lower. Okay, so remember, again, from a few months to a few years, this a bull market takes longer to build, and a bear market short and sharp. Yeah, so you'll see a graph just now of the JC All share is more than nearly 10 years old now, where bear market will be short and sweeter. I believe we should have a bear market, bring the prices back to more realistic levels. As I say, get rid of that greed. That gets to the stage where we have this euphoria, we have a blow off. So having a bit of a healthy correction and then followed by a bear market is good. Brings prices back to more realistic levels. Okay, so that's why we call it primary bull and primary bear. Then we have within the bull market, we have these little pullbacks or called corrections. So when you read in the newspaper or online about the market correcting, you know it's these little pullbacks. So every single point in the graph is a buyer and a seller. Someone up top there is buying and someone's selling. Someone at the bottom here is buying and someone's selling. One of them is wrong. But when we have this pullback, obviously we have more sellers than buyers pushing the price down. Okay. And that's why we call it correcting. The market's correcting. In the bear market, these are what I call rallies, where this is a rise against the long-term or the primary trend. Those are called rallies. The market is rallying. Okay, lasts from a few weeks to a few months. Okay, so shorter term. And then the minor trend or daily fluctuations is today's close compared to yesterday's close, or today's close compared to last week's close. So it's much shorter term nature. And this is where I think a lot of traders fall into a trap, is looking at short term. Your goal is, even as a short term trader, is identify the long term primary trend. From there, the corrections, and from there we chunk down. Okay, we were talking about price action just now. So those are cycle analysis. And you ask yourself the question the whole time, where are we right now? Then we get what they call trends. They have 2 kinds of markets. Either we're trending up, okay, we're trending up, or we're trending down. That's one kind of market. Okay, a third of the time the market's moving sideways. Okay, sideways markets, what we call trendless market. Okay, here we got more buyers and sellers pushing the price up. Here we got more sellers and buyers pushing the price down. In the sideways market, which happens about a third of the time, it's a consolidation phase. There's a pause in the market. The market's taking a breather, which is good. You know, you want to see the buyers and sellers waiting for new information, and then if the news is positive, it'll break out and continue up, or breaks down and continues downwards. Okay, so a third of the time the market's moving in a sideways trendless market. Okay, so that is just some of the terminology also. Let's build up on that now. So we talk about support and resistance levels. In a rising bull market, you have more buyers and sellers pushing the price up. We hit an area of resistance. Just think of resistance as sellers, more sellers trying to push the price down, people trying to take the profits. it meets the area of support, more buyers coming to the market, and I always think of the psychology behind it. So we hit an area of support. These buyers coming to the market now is the buyers that did not get in at a much lower level. So that's this example, that's 5 Rand. It rallied as high as 10 Rand. Now we pulled back to 8 Rand. So 20% off there. So the guys that are getting in now think, well, the market's 10, it was 10 Rand, and now I'm buying it at 8 Rand, the market's cheaper. But the minute we go up and we break above our resistance, we take out all the sellers, we break above that level, then we're in a rising market, we're in a bull market. Okay, so we hit areas of resistance again. So people that maybe bought at the bottom here, and think, okay, let's take my profits, and the more sellers come to the market, pushes the price down again. The minute we break out above a previous resistance, we have again confirmation that the market is going up higher. But what's interesting to note is that the previous resistance will act as a support. I call them turning points. And your goal as a technical analyst or a charter is to try and anticipate how far will the market pull back. So what doesn't happen all the time. It does happen sometimes. So this helps you as a way of forecasting where will the market pull back to. So previous resistance will act as support. In a falling market, how far will it rally? Previous support will be resistance. So you can anticipate. There's my little rally, that little scenario there. Okay, so I just wanted to bring into those terminologies, resistance being sellers and support being buyers. Just understand it's the previous peak or the previous support trough or low. Okay. Let's move a bit to the next tool. This is a very powerful tool to use, is what we call trend lines. So, as the word implied, it helps you to establish the trend. Usually, you would find a prominent high or prominent low as a starting point. So, in this situation, find a prominent low, project it to a second point, and then from there, extrapolate. The more times it touches, the more reliable it is. The longer it takes, the more reliable it is. Okay, so as long as the share price it stays above that support trend line. Remember, all those points of touching is where buyers are coming into the market. We're supporting the prices. Okay, so we come back and touch and we kiss and we move away. Kiss and move away. Okay, so in the rising bull market, support, as long as the share price stays above it, the trend is up. But the minute it breaks down through it, and this is where you might want to have some rules, it must close below that support trend line. And I like to use a 3% rule. It must close at least 3% to confirm a change in trend. And that will be a trigger to sell or to obviously get out of the share price. In a falling market, in a bear market, as long as the share price stays below that resistance trend line, remember resistance is areas of sellers. Okay, we need to break out above that resistance trend line to go from change a trend from a downtrend to an uptrend. So use your trend lines as the trigger to get into the market. Again, you might want to use a rule of 3%. It must close above a support trend line. Otherwise, you get what they call whipsaws or false signals. Okay. In the sideways market, important to have those support and resistance trend lines in place because you'll act them as a resistance. And by the way, you can see the colors I'm using there. I like to use red as support and blues as resistance. The more visual you can make your analysis, the easier it is. Okay. You always say, believe what you're seeing on the charts, and this is one of the tools that you can use. Okay. So here's an example of the JC All Shares, a barometer of all the shares in the market. You can see here we're going right back to the start of the bull market, at the end of the bear market in 2008. This was a subprime story. That pullback there was a 45% drop. It took the market more than 2 years to break even. So what I've done now, yes, hindsight's a perfect science, but I've taken from a prominent low and projected it out to a second point there. So they don't touch twice, but you can see that's what they call a support trend line. Support trend lines, by the way, are diagonal. You can also see the angle here, by the way. If you look at this angle here, it's roughly about a 45-degree angle. 45-degree angle, that trend line is a sustainable trend line. Okay, so the share price rallied, and then we hit a resistance level, pulled back. By the way, I also connected the highs up top there, and you can see it also ultimately long-term, this long-term bull market until the end of, well, still going up higher, but you can see for long-term, a long time it was trading in an up channel. Okay, so that was our resistance trend line. Remember, again, diagonally are trend lines. Horizontally, we call them support levels. So the market rallies to a certain resistance level, pulls back to support. That's the 3 or 4 times there, quite reliable, and same thing there. That's a few times there. Then you can see also, as I say, this point in time was a correction. Okay, until such time we broke up above our previous high, then we had a bull market. You can see it broke out above it, pulled back a bit. Sorry, hit it, didn't go above it for a long time, moved sideways, and eventually broke it, touched again the third time, broke out above it, came back to retest. So previous resistance will be support, and then it rallied up a bit higher. Okay, you see we went as high as up top here again. There's a support level, there's your resistance level, and you see for nearly 2 years we moved sideways, and then most recently we broke out of it. You can source again, retest it again, and then accelerated further. Okay, that gives you a picture until about 2 or 3 days ago. Okay, so you can see that long-term bull market. So what you just saw now is what they call a Japanese candlestick, which is a price chart. The easiest way to show a price chart is a closing line chart. The closing price connected every day will create what we call a closing line chart. It's the easiest way to show the trend of the market. By the way, it's two-dimensional. You get price reflected here in cents on the vertical axis against the time horizon, which is on the horizontal axis. This is showing roughly about 250 days, which is about a year. Okay, but just with the naked eye, I can see support and resistance level. So just want to highlight again, review what we just spoke about now. You can see that was a support, bounced off there. Okay, went a bit higher. You see just a naked eye there, 1, 2, 3 times, and then 4 times. That's very, very important resistance level. So we rallied from here, bounced up, came back again. So it goes on. Previous support there will become support here, will become support here. You can see now with the naked eye, I can see a sideways market. So this is PSG. Since April this year, we've been moving sideways, roughly between 233 Rand a share, as high as 265. So you can see that's what we call a trading range. We need to break out above that. So again, what I've done, I've taken from a prominent low, connected the second point out there, and I connect up top here, touch there, touch there. That's a very, very important resistance trend line. Ultimately, this will create what I call a triangle chart pattern. So we're going to either break up or we break down from it, but it should be a continuation pattern. Okay. So go one step further now. We mentioned just now about a Japanese candlestick. One of the most powerful ways to understand how to interpret price action. Remember, price action is your primary indicator. So with a closing line chart, you only get the closing price. With a candlestick, you're getting much more information. You'll get the high for the day. Let me bring my cursor here. Okay. Intraday, the price reached as high as a high, and intraday made a low. This is what they call the real body. So this is what they call a hollow body. It's not filled in. What's important, you'll find this is where the market opened, and that's where the market closed. So as long as the close is higher than the open, we'll have a hollow body. Okay. So when we talk about candlesticks, people always think of this as being the candle, and that would be the wick. Okay. We're also going to refer to as the upper shadow or the lower shadow. But these are little wicks. What's important is the relationship between the open and the close, and we'll go into more detail about that just now. When the close is lower than the open, so that's when the market opened, okay, but it closed much lower, you'll see it'd be a full body. What do we call a full body? Those would be a down day. So down days, and it's easier to just look at the chart, and you see the up days will be bullish, and the down days will be obviously bearish. But we're going to show you some practical examples. Okay, so there we go. This is again that same chart you saw just now. I've just zoomed in now to show you the candlesticks. This is again PSG. So you can see these long bars here. That's where that's where the market opened. That's where it closed. Intraday we tried to push the price higher, but eventually settled at that level there. Okay, but it's near the high. Next day we opened a bit lower. Okay, but we still closed higher. And again, the buyers told, can you see this tug of war going on? So the buyers still tried to push the price higher, but it was an up day. And then we opened at the same price that we closed, and we had a very long day that day, very long trade. That's where we closed. Next day, we created what they call a doji. That's where you can see the close and the open and close are very much the same level, creates a bit of a cross. Dojis is a sign of indecision. So we find that next day the market opened much lower. That's where the market opened, and that's where it closed. You can see intraday the bulls are trying to push the price higher, But you can see the war between the buyers and the sellers are starting to win. You can see for 3 or 4 days, the buyers were in place, the sellers were in place. And so it goes on. Yeah, we have another little doji, still a lot of indecisions in the market. So this is how you start interpreting these charts. That relationship between the close and the open, very, very important. So there we see the price was opened slightly lower than the previous day's low, but we had a really long down day. There we opened, we tried to push a bit higher, and the next day it's opened a slightly bit lower. But you can see in that sideways market that there was not much action. But you can also see the range, the candlesticks were much shorter. Then we had a very long day. Here's another very long day here, but it's all very bearish. That was a bit of a piercing line. Okay, the close was much higher than the previous day, the previous day's close. Another negative day, and then we had some down days, and we had some dojis, and so it goes on. But let me introduce what we just spoke about just now. When would I get into it? I use my trend lines because I connected the highs of the day. They touched 3 times, extrapolated 4 times, 5 times. That's very reliable. So there we have a scenario now for a first time for 5-6 days that we have a first day that we have a bullish day. And you can also see there's a gap between where we opened and where we closed the previous day. So here you can see a bit of panic buying. Get me in. So obviously my trend line will be my trigger. You can see the market try to push a bit higher that day. The next day the market jumped up big time. There's an open compared to the previous close. So that was a serious turning point. Okay, then we had a bit of a sideways market. We hit our previous resistance level, pulled back a bit, and again, another big gap there. In Japanese candlestick terms, we call that a window. And by the way, you can see this window at the bottom here was not closed, so that's very, very bullish side. This window here also wasn't closed. We broke above it. We had a bit of a doji indecision sideways market again, and so it goes on. But that's where you would have got in, around about over here, well, dealing in that candle. But I can extrapolate it out again, and let's see, okay, as long as it stays above that trend line, the trend is still up. Okay, at this point in time, my previous resistance becomes support. Now, you would have gone short here, but it's important what we're going to do to sell out. Always wait for confirmed close. By the way, PSG went up higher today. Okay, so that would not have been a good signal. Okay, to have got out. So you would have held that share price. Previous resistance will be support. Okay, here's NASPAC, because this always comes up in conversation, is that what about NASPAC? NASPAC is notorious for windows, these little gaps. So I've tried to zoom in just to show you some price action here. There's an area of support. There's a breakout. There's that window again. The same scenario we saw with PG just now. For a long time, we had, well, 2 days, we had negative days. We had a bullish day. It was up day there. Broke above it. That window wasn't closed. Rallied up. And we broke up above our previous resistance. Another window there. So it's panic buying. Get me in at any price. Okay. You see we had area of resistance. The market pulled back a bit. There was a full-on doji, bit of a star. It's out of everybody's zone. That was unexpected. Again, we gap down, exhaustion gap up, breakaway gap, and so it rallied. Okay, there we can see again we hit area of resistance. More windows here. A lot more windows, but just using the trend lines, you can see sideways market, broke up out of a window and closed up. That was a very, very strong buy signal. Okay, and then you can see you can bring in your trend lines here as long as it stays above that long-term trend line. Very, very powerful hold signal, call it that. So you would have said, okay, that was a close here. Remember, it doesn't close below my trend line. And today, by the way, NASPAC did not close below this. It hasn't broken below this trend line. It's actually very, very strong up still. Okay, because NASPAC, in what happens in Hang Seng, and that's why we have these little gaps. Because remember, NASPAC every day is 10 cent. If 10 cent rallies, I think it was rallied 4% this morning, you anticipate that NASPAC will open up 4% higher. And that's why we create all these little windows in place. But you can see what I've just highlighted for you guys. Higher highs, higher lows, okay? And sideways markets and using trend lines, very, very powerful indicators. Let's build up on that now. One of the first technical indicators you want to learn about is moving averages. So yeah, I'm using a 50-day and a 200-day moving average. When the 50-day crosses, the 50 days your red line, when it crosses below your 200-day moving average, it's confirmation change in trend. So anything below that cross, that we call the death cross. Anything below that is bearish, is negative. Took market nearly a year, more than a year, to recover. With a 50-day went above the 50-day, above the 200-day. Confirmation, change in trend from a bull market to a bear market. That's what we call the golden cross. As long as the share price stay above it, the trend is bullish. Okay. But there are disadvantages of the moving average. Obviously, it gets me a bit too late and gets me not a bit too late, but confirms changing trend. And that's what it's all about, trend analysis. Big thing now with moving averages, it doesn't work well in a sideways market. So that's why it's important. If you just use the 50-day moving average, you're going to have a lot of false signals. Buy, sell, buy, sell, buy, sell. Who's making money in that scenario would be the broker. That's why I'm suggesting using two moving averages. And yes, I'm using a 50-day and a 200-day because I'm trying to establish the long-term primary bull cycle. So you might use a 21-day and a 40-day as the intermediate, and you might use a 7-day and a 15-day as a shorter term. Doesn't matter as long as you have two different moving average crossovers. Okay. So also what's important here is to understand that moving averages can also act as a support level. You can see here this 200-day moving average, the market pulls back to this 200-day moving average. Here's a scenario, if I go back again, where the 200-day moving average acted like resistance. Okay, so it also highlights turning points for you. Here's first rand. First rand for long-term, you can see the sideways market here. There's your 200-day acting as a resistance trend line. When it broke up above it, above resistance and above your 200-day moving average was a very reliable entry point into that share. Yeah, you can also see how the 200-day moving averages acts as support. Yeah, it was acting as resistance. Yeah, it acts as support. So as long as the share price staying above it, it will be bullish. Okay. So guys, I hope you've enjoyed today's presentation. Just a quick summary. Basic cycle analysis. Ask yourself the question, what kind of cycle are we in? What is a primary bull, primary bear? As long as we have higher highs, higher lows, it's primary bull. Lower lows, lower highs, we primary bear. Okay. Where are we in a secondary cycle? Are we in corrections or are we in rallies? Okay. Now ask yourself a very important question. Are we in a trending market? Are we trending up or are we trending down? Or we're going to a sideways trendless market. So use those tools. Support and resistance. Remember those levels are horizontal, trend lines are diagonal. Okay, and then price charts, I've introduced you to Japanese candlesticks, and overlaid on top of that would be moving averages, just give you further confirmation. So these are basic technical tools. They are the foundation to any technical analysis, and that's how you start making decisions in the market. So in the conclusion, here's your homework as such. The presentation, the PDF, as well as the recording will be emailed to you. Please refer to tutorials 8 and 9. You'll see that one of the slides I highlighted to be the links. You can click on our website or go to our homepage, PSG, and then scroll right down to the bottom and find the FAQ section under support, and you'll find tutorials, and that will take you through to additional information. But next week, as I say, we'll be talking about risk management next week, Friday at 1 o'clock. So from my side, thank you very much for being on this webinar again. Any questions you have, please drop us an email. There's our team email and there's our team phone number. But we are there to help you with any questions you have. Okay, so from my side, thank you very much for being on this webinar. Until next time, all the best. Bye for now.